Welcome back. Now, South Africa is reviewing one of its most important benchmarks in the financial system, the prime lending rate. The prime rate has been set at a fixed margin above the repo rate for more than 2 decades, but questions are now being raised about whether this framework is still fit for purpose in today's banking and interest rate environment. For a look into what this review means for borrowers, banks, and the broader economy, we're joined now by Izak Odendaal, investment strategist at Old Mutual Wealth. Izak, thanks so much for your time today. Now, what does this review actually mean? A change in the prime lending rate or a rethink on how the prime rate is actually set?
Yeah, it could be one of those two things. The one is whether we need this benchmark rate that all the banks link their loan rates to, if, in other words, a common benchmark rate across the industry, or should we just leave banks to kind of do their own thing? Mm-hmm. And then secondly, there's a question mark around whether, if we are going to have a fixed rate across the industry, where should we peg that relative to the repo rate? Because, of course, when this was introduced, this 3.5 percentage point gap back in 2001, the repo rate was a lot higher. So that 3.5 percentage point spread was basically a third of the repo rate. Today, it is 50% of the repo rate. So as interest rates move down structurally, the question mark is whether that fixed 3.5 percentage point gap is still appropriate. Should it be smaller or not? So I think those are sort of the two questions. It's not clear exactly which of those two the Reserve Bank will be focusing on in its review. And obviously, it will be talking to the banking industry in this process. But I think those are essentially the two questions that we want to think about.
Mm-hmm. And you know what I found interesting while I was doing some reading for the interview was a News 24 article that showed that all the parties seem to be pointing fingers at each other when asked questions, right, around how the prime rate is determined after it emerged around, or that 3.5% differential emerged around 2001. The SARB seems to be pointing to banks pointing to the industry body, and no clear answer on why that gap currently exists. What do you make of, I guess, the lack of clarity?
Well, I mean, I think partly it's been around so long. It's almost as if we've kind of taken it for granted, and we don't investigate whether it is still appropriate. And I think so. I mean, the timing of this review is good. I mean, back in 2009, there was a formal report that the Reserve Bank plus the banking industry sort of collaborated on, and they talked about this issue, and they decided that at that point there were pros and cons. And if essentially, given that there were pros and cons, they didn't see any need to change back then. But that was, 16 years ago. So I think it is time to think about it once again.
And if this change does come through, could it realistically lower debt servicing costs for consumers, for small businesses, or would it likely be a marginal difference?
Yeah, so you need to remember that banks already, they don't just charge you the prime rate.
Yes.
They will look at your own credit risk, and they will look at their own credit risk appetite, and they will look at the state of the economy, etc., and then they will give you a loan. And that loan might be prime -2 or -1 or prime plus or whatever. So for any typical borrower, your loan already reflects your own credit risk profile and the bank's risk appetite. And in that sense, changing prime or changing the spread is not going to make a huge difference. However, if the decision is made that the spread should be, let's say, 3% instead of 3.5%, then obviously all of us who have loans linked to prime, such as your mortgage, and my mortgage is linked to prime, and therefore if prime is lowered, then all those mortgage rates will come down automatically. So those people will benefit. And I think that's kind of going to be the debate in this process, is to say, well, new borrowers will not benefit from this change, but old borrowers or existing borrowers might benefit. Is that fair? What is the impact on the banking industry? What's the impact on banking margins? Those are kind of the things that are going to be discussed and looked at as this review is conducted.
Yeah, and I think it's quite important to, of course, make note that one's credit risk profile still remains important when, trying to get any debt or, for your car financing, for your home, etc., etc. You touched on this for a bit, that it seemed like no one really worried about it because it's something that had been done years ago. And with, I guess, also that inflation rate being lowered, I'm sure that also makes it even, or inflation target that is being lowered, I'm sure it makes it a bit more timely as well.
Yeah, because essentially, 3% inflation implies ultimately much lower interest rates. It implies a repo rate of, let's say, around 5%, give or take, depending on where we are in the cycle. And so once again, if your repo rate's 5% and you then slap a 3.5% spread on top of that, that's quite big. And maybe, in a lower inflation environment, structurally lower interest rates, that spread should be much lower. I mean, I think there is a case to be made for us to have a prime rate because it makes it easy for consumers to compare, right? So if you go and you want to take out a home loan, Bank A is giving you prime -1, Bank B is giving you prime minus 50 basis points. It makes it easy for you to know, I should go with the first bank. Rather than banks kind of each coming up with their own way of framing the rate that they are offering. So there's a case to be made for us to maintain this prime as a reference rate to make it easy for consumers to understand what's going on. But as we discussed earlier, your own credit profile is still going to be crucial in terms of what the bank actually offers you on a loan.
A really important conversation, and we'll be watching how everything unfolds, particularly with that review, the SARB review that is. Izak, thank you so much for your time and sharing your insights with us today. That was Izak Odendaal, investment strategist at Old Mutual Wealth.